And we're back at 40 minutes after. President Obama is expected to announce his plan to revamp the financial regulatory system this week. What will he change and how will it affect the Federal Reserve and the S.E.C? For more on this, we turn to two experts in those areas. Arthur Levitt is former S.E.C. chairman and advisor to Goldman Sachs and a Bloomberg board member. And from Washington, D.C., we're joined by Laurence Meyer, vice chairman of Macroeconomic Adivers and a former governor of the Federal Reserve Board. Also with us, our own Peter Cook in Washington. So, gentlemen, good morning.
Good morning, Carol.
Arthur,
good morning.
Good morning to both of you. Arthur, I want to start with you. I mean, in terms of what we've gone through in the past year and a half, what have we learned and what has it shown us that we've got to change about the regulatory system?
We've learned that we don't know enough. We've learned that we don't have the kind of transparency. We've learned that firms are playing regulatory arbitrage with a myriad of regulators and a myriad of systems. But in my judgment, the most important thing we have learned, which we have not yet addressed, is the vital importance of accounting in this process. How are institutions going to account for a variety of transactions that still is opaque, it still is confusing, it still is undetermined, and even in the light of what appears to be a rollout of a new regulatory scheme headed by a council of regulators.
Larry, let me bring you into this. In terms of what we've learned over the last year and a half, what do you think, hopefully, we've learned and that's got to be changed in the system?
Well, I think one very important thing is that we need someone who's overseeing the supervision and regulation of all systemically important institutions. That would have included standalone investment banks in the current circumstances and insurance companies. So I think that is, crucially important. And in addition, we probably needed to see some oversight of key new markets that were expanding very rapidly, like asset-backed securities and credit derivatives. And I think that's one of the things this plan addresses. And third, this plan also addresses the fact that we need someone with resolution authority over all financial services companies.
Peter, Larry, let me jump in here. Yeah, if I could, Carol, I just want to jump in on that. The first point you made about a new entity to oversee systemically important institutions. Every indication is the Fed is going to be that group with this council of regulators. But the Fed's going to take the lead on this. The Fed's going to have a lot of responsibility. There's some in Congress saying the Fed doesn't deserve that responsibility. Didn't see this crisis coming. It can't prove to us it's capable of doing this. How would you respond to that?
Well, I think that's going to be one of the most controversial parts of the program. The Fed is the natural place for this. Central banks ought to be intimately involved in supervision and regulation. I think we see the experience in some countries where the central bank was taken out of those responsibilities as having worked very poorly in this particular crisis. So I think it's very controversial, to be sure, but understandable and an excellent idea.
You know, Arthur, let me bring you into this, because the Fed certainly didn't get in front of those weak lending practices that led to where we are. I mean, should Fed be the kind of the uber regulator here?
Nobody covered themselves with glory, and it isn't a question just of oversight by the Fed, which I think was weak. It was a question of oversight by the Congress, which was even weaker. And the battle essentially has been, do we want a single overseer which will command the regulatory landscape? And Congress clearly said, no, we don't want the Federal Reserve to be that single entity. And for that reason, I believe we're seeing this council of regulators that will work with the Fed in terms of doing the job. I think that's probably a reasonable compromise.
I'm sitting at home and I'm thinking there were a lot of regulators, a lot of pairs of eyes that were supposed to be keeping watch on this situation, yet here we are still cleaning up the mess. Who's to say by having several people still kind of in charge, is that the answer, Arthur?
There is no answer. I think the key to any effective regulation is not exactly what it does at a point in time, but its responsiveness to change. The kind of system we have today with the Fed as the super regulator with the Council of Regulators may be absolutely perfect for today and totally inappropriate for a year from now or 2 years from now. And it's up to Congress and the administration to trim sails where necessary. What we had happen was regulation fell far behind the enterprise and innovation of American business, which really escaped the regulatory net for a good number of years.
That's a great point. Larry, can we keep up with innovation? Because, you know, it was interesting as we went through this mess over the last year and a half, folks would come on, very smart people in the financial industry who didn't seem to even kind of really have a grasp of what was going on. Can regulators keep up? We've got 30 seconds before we have to take a break.
Well, I think that's challenging, but one of the dimensions of a systemic regulator is to step back from institution by institution oversight and look for emerging systemic risk. What's happening in markets, what's happening in instruments and financial practices. So look for things that are growing very rapidly and are outside of the supervisory and regulatory system. So I think that will help. Whether it will prevent the future crises remains to be seen.
All right, hold on. We're going to take a break and come back. We're talking with Larry Meyer and Arthur Levitt. Stick around. We're talking about the regulatory environment. We're back in 2 minutes' time. 47 minutes after, talking about financial regulation in our roundtable with Arthur Levitt, former S.E.C. chairman, and also with us from Washington, D.C. is Larry Meyer. He's a former vice chairman, a former governor, of the Federal Reserve Board. Forgive me. Larry, I want to start back with you. Winners and losers in terms of how this shakes out among those regulatory bodies. Who do you think it will be?
Well, clearly the OTS is the bigger loser because they're gone, basically merged into the O.C.C. The Fed is perhaps the biggest winner in terms of increased authority over systemically important institutions. What we don't know is whether Congress will also remove some of the Fed's authority in other areas to sort of balance that.
Arthur,
Larry, let me pick up on that. If I could, Carol, sorry, let me just ask you, this idea of a single consolidated regulator for banks, there are a lot of members of Congress, both parties, who say there should only be one. We've got too much alphabet soup in terms of regulatory agencies. Getting rid of the OTS is not enough.
Yes, I think that, first of all, consolidated supervision of all systemically important institutions naturally fits with the Fed. And the question is whether the Fed should also get supervisory authority over the banks themselves. This is also a political issue. The OCC is going to retain most of its powers, maybe have expanded powers, so that's just not going to happen.
Arthur, let me bring you into this. What does this mean for the S.E.C.? Former head of the S.E.C., what do you think it means for the future of the S.E.C. here?
I think a commitment has been made to retain, nurture, and encourage the S.E.C. to give it additional resources, to make it part of the Council of Overseers, so that I think it's a likely win for the S.E.C. The fear that the S.E.C. would lose its authority to some consumer agency of some sort has yet to play out. They haven't defined what responsibilities that new consumer, I call it a Betty Crocker-like agency, will have. But I think it unlikely that the S.E.C. will lose investment management as part of its critical mandate.
We have about a minute left here. Arthur, let me start with you, 30 seconds. What about, though, the thought of an international regulator? Because it's not just the U.S. markets we have to think about, because all of this, as we saw in this crisis, affected everybody globally.
I think this is such a huge issue. Let's solve it here at home with our own sovereignty. I think we can coordinate a lot better internationally, and we will, but I think we've first got to attend to our needs and our regulatory system. We've got to get the resolution authority straightened out, and we've got to get Congress to sign on to what is a fairly comprehensive proposal.
A lot to do. 15 seconds left, Larry. Your thought in terms of an international regulator?
I don't think that's going to happen. I don't think the U.S. will want to cede its authority to an international regulator. What we will see is a lot better coordination across countries.
All right, we're going to leave it on that note. Larry Meyer, thank you so much. Also, Arthur Levitt and our own Peter Cook. Thank you to all of you.